So there's been a lot of talk about a bubble in the stock market recently, but what we've seen instead has looked like 10 years of volatility compressed into a few quarters. But with volatility comes opportunity, and I think I found a pretty good opportunity. So I just bought a brand new stock. It is a brand new position that I am putting $5,000 into, and we'll be covering what I bought, why I bought it, why it looks like such a good deal. We'll cover all of it. We also have a lot of other news to get into that's affecting stocks. The biggest is the Fed's change in direction on interest rates, something that will have a huge impact on stocks, but for disciplined investors, we can play this to our advantage. We'll also get some commentary from other folks like Tom Lee on the rise in stocks and how interest rates will impact the market over the next year. And then we have a bunch of other stuff to get into. SoFi stock is now up 23% in the past month, so we'll talk about what's next for the company, especially in the current economic environment. Google has unveiled their new Pixel lineup, and they are leaning heavily into AI. No surprises there. Google is a bit of a bellwether for AI, so we'll see what this means for their stock price, especially given that Meta has actually frozen AI hiring, and ChatGPT maker Sam Altman even called AI a bubble a while back. And we'll wrap with the latest numbers out of China that indicate their economy might be cooling down and what that means for global markets, especially with Apple's newly announced $600 billion investment into US manufacturing. There's a lot to cover this week, so let's start with my brand new stock position. The stock is in the information technology space, and the position is PayPal. I'm buying $5,000 in PayPal, and there's three huge opportunities for new investors here, but there's also two big risks that we should watch out for. So PayPal may seem like kind of a dinosaur in the technology space, but one of the biggest opportunities in this stock right now is their incredibly low price today. According to Forecaster, they are currently trading 68% below the fair value of the company. We'll look at that more in a minute, but the reason the stock price is so cheap is because the company has experienced a 65% drop in their stock price over the past 5 years. The company has been struggling a lot in recent years. They're a pretty far cry away from the PayPal mafia days, and the company currently trades at a PE ratio of 15, which is actually lower than the average for the overall stock market, even though this is a technology company. So the big question here is, one, will the company's valuation return to a more normal level for a tech company? But also longer term, can the company move from sort of the old school entrenched mode and back into growth mode? And that's where the second big opportunity shows up for PayPal, is in their new leadership. So CEO Alex Chriss, who actually took the helm in 2023, has been strongly pushing the company to move beyond just another payments processor and actually focus on innovating in the payment space. He actually had this quote that PayPal has lost its way a little bit from an innovation standpoint. See, even though PayPal hasn't been super innovative, they have 400 million consumers using their platform and 35 million merchants. Their user base is just massive. They just haven't been using them that effectively up until now. And so the big bet here is, will the new CEO be able to use it more effectively? And there's a few good signs that they may be able to do this. One, the CEO is focused on turning PayPal into the ultimate matchmaker between merchants and consumers. So they're really focusing on pushing the now 26-year-old company to start moving faster like they did in the early days. How they'll do this is by using 4 what they call strategic growth drivers. So here they are, and each one focuses on a different aspect of PayPal's business. But how they work together, as we'll see in a second, is what's really key to PayPal's future. So the first growth driver is winning checkout, making PayPal the default checkout option on every website. I mean, hey, 20% off Taco Bell means a lot nowadays. Number 2 is scaling Omni and Venmo. And Venmo is a huge way to transfer money in the US, and it's really big on college campuses. Number 3 is making more money as a payment service provider, basically transaction fees. And number 4 is the big area where I see potential for PayPal's future, which is scaling the next generation of growth. And the biggest play here is PayPal World. See, PayPal's new CEO is starting to envision PayPal as controlling the world's digital wallets and connecting them all together. A digital wallet might be a PayPal account, but it also might be a crypto account, or it might be something you hold on a whole nother platform. You have all these different digital wallets, but they still communicate as if they were physical banks. I mean, 3 to 5 days to send money to someone in the US, and if you're sending it internationally, it could take a lot longer. I actually do a decent amount of international payments. I have my editor who works outside the US, and it took us a while to figure out how do we even send money back and forth. You'd think this would be a solved problem, but it really isn't so far, and PayPal might be one of the only companies that's big enough to actually put a dent in this problem. But what I like about this is less focus on the specific strategy. I mean, I think the strategy makes sense. The big thing for me is that they are now focusing on innovation, which they haven't done for a long time. And given the company's stock price is so low, it won't take that much innovation to bring this back up to a reasonable return. So Forecaster actually calculates the fair value stock price using 4 different methods, and I actually really like this approach because there's a lot of different ways to figure out how much a company is worth. One is by using its discounted cash flow. This is how Warren Buffett values stocks. Like, imagine you could never sell a stock again. How much cash would it have to give you to make it worth it for you to hold on to it? The second is the Peter Lynch ratio, which is basically just the PE ratio for an average stock like this converted back to the stock price. The third is economic value added, basically how much money does it generate for a lot of upfront capital. If you're a big industrial company, that matters a lot. And the last is EV to sales. What is your company worth compared to your overall revenue? So when you average those together, you get an average fair value of 118 according to Forecaster, and PayPal's current stock price sits at 70. So even if the company were just to return to a fairly average valuation, there is upside in the stock, but the bigger play is if they can return to growth and actually start to take on new markets. That has much larger upside. But that's not guaranteed to happen. There are 2 major risks that we need to look at for this company. The first is turnaround risk. PayPal's stock price is not moving in the right direction right now, and anytime you have to bet on a stock reversing direction, there's a risk that it just keeps on going the way that it's already been going. Now, because PayPal is changing strategy and focusing more on innovation and less on acquisitions, that does make me feel better about the turnaround risk. But there's a second risk that we need to look at that ties in with our second topic today. So if you haven't been following all the drama around the Fed and interest rates, which seems like the strangest thing to have drama around, but the Fed's goal has basically been to get us as close as possible to 2% inflation, get us away from the high inflation that we've been seeing recently. At the same time, the current administration has been pushing the Fed to lower interest rates, which boosts stocks, it boosts equities, basically heats up the economy. And we learned recently that Fed Chairman Jerome Powell may actually be considering interest rate cuts in the relatively near future. This is a big deal because there's been a split at the Fed as different parts of the Fed have been debating should we raise interest rates or lower them. This is the first time this has happened in multiple decades, and so the fact that they were split is a big deal. But some shakiness in the job market seems to be changing up Jerome Powell's stance. You don't want to lower interest rates too early because that can actually heat up inflation, but lowering rates can also help the job market start to grow again. July job numbers were a little bit short of what a lot of folks were forecasting, and so because of that, there may be reasons to start cutting interest rates maybe as soon as September. If this happens, it is going to be a big benefit to smaller, high-growth stocks because these companies often rely on borrowing to grow, but it's also going to have a big impact on PayPal, which we'll look at in a moment. But first, let's look at Tom Lee's prediction for what this interest rate change means for the market.
I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps. And I think one of the leaders probably comes from the financial sector. The broadening is really the financials, industrials, and small caps.
So Tom Lee thinks that as interest rates start to get lower, a big area to invest will be the stocks that have already done well, but also in financials, industrials, and in some of the smaller cap companies that can use the borrowed money to grow more. One stock that hits on a couple of those trends is SoFi, who's seen their stock price rise by over 20% in the past month. Some people think that this has to do primarily with the potential of a rate cut benefiting SoFi. And I think another piece of it is the market starting to recognize some of the value that SoFi has beyond just another financial app. I mean, we saw PayPal is getting into crypto. SoFi has actually enabled crypto investing for quite a while. They temporarily dropped it in late 2023 when they became a regulated bank. And now the company is actually moving moving back into it. So look, I don't know if this 22% gain will last or if it'll go away again, but over a long period, I do expect SoFi stock price to continue to rise as they continue to create more value for their members. Just wanted to keep you updated on my latest SoFi stocks, but meanwhile, in the AI space, Google has recently announced their new Pixel line of phones, the Pixel 10, which, probably to no one's surprise, is very heavily focused on AI, and maybe to some people's surprise, also Jimmy Fallon. What's interesting about this focus, though, is that it comes at the same time as Meta, which has been poaching a bunch of the top AI talent from companies like OpenAI, has actually announced a hiring freeze after their big blockbuster spending spree. So this is after they have already poached as many as 50 AI researchers and engineers. Part of the issue here is just how much money they're spending on acquiring this talent. Analysts have actually warned how much stock-based compensation is showing up in the company. Basically, they're issuing new shares to these engineers and top researchers in the millions, tens, or even hundreds of millions of dollars. And so all those new shares put downward pressure on the stock price. They kind of dilute all the shares that are already out there. Another worry, though, is at the same time, OpenAI's Sam Altman has said that he actually sees an AI bubble forming as the industry surges. There was an interesting MIT report that came out recently that looked at generative AI startups and pilots, and it actually found that 95% of generative AI pilots at companies were failing, meaning a company tried to use AI and it wasn't able to use it effectively. Now, this isn't super surprising to me. AI is a tool, it is not a solution in itself, and there's been so much marketing hype around AI that I'm sure a lot of companies are trying to use it for things that it's not really designed to do. This to me shows that the pendulum has finally swung too far the other way and it will start to swing back, but I don't think it means that AI has no value. And ultimately what matters is how much money do these companies make, and can the AI make them more money in the future or not? I actually own a fair amount of shares in Google, or Alphabet, $25,000, and so my bet is that it will continue to create value, but it may pull back a little bit, especially in some of these smaller companies under $5 billion, where it's not entirely clear if they actually have new AI tech or if it's just marketing wrapped around ChatGPT. But that takes us to one of the biggest news reports over the past month, which is what's been happening over in China. So let's take a look at how the Chinese economy could affect global stocks, and then we'll get back to how PayPal may perform in the current economic environment. So if you haven't been following super closely, China's July data showed that prices were continuing to drop in the output from their factories. And at the same time, China's youth jobless rate has risen to 17.8%. Now, on their own, neither of these is end of the world, but they do signal some shakiness in the Chinese economy. And one thing that I thought was really interesting is if we look at the general Chinese employment rate, it's fairly steady. In fact, it is so steady that a lot of economists think that this data isn't really real. China's just kind of making up numbers. But their youth unemployment rate seems to be a little bit more realistic. And while it's not at the highs we saw in 2023, it is absolutely on a major upswing from even where it was last month, which seems to indicate that there's less demand for cheap labor at the moment. On top of this, we're still seeing some craziness in the Chinese property market. Chinese property developer Evergrande has actually been delisted from the Hong Kong Stock Exchange, which is absolutely crazy considering this company was once listed for over $51 billion. So a lot of wealth in China is kind of just evaporating right now. Now, at least for the rest of the world, this seems to be mostly fairly contained to China at the moment. The big issue here would be any kind of big policy change by the CCP that could affect manufacturing that then affects our supply chains around the world. One kind of trend that we've been seeing is Chinese companies that will actually run factories in the US, trying to get around some of the tariff issues that have been happening recently. So even with some companies like Apple committing to invest more in US manufacturing, the current administration is also concerned about the growing relationship between China, Russia, and India amid the current tariffs. But it is always worth keeping an eye on what exactly is happening in China at the moment, because they do have a big impact on the global economy. But lastly, let's look at what Fed interest rates could mean for PayPal as a stock. And then I actually have a second stock that I want to briefly cover that just reported earnings, and it's actually my biggest stock holding overall. So PayPal will be impacted by interest rates in two ways. First as a tech company, and second as a bank. Now, when interest rates drop, that is going to hurt the amount of money that PayPal makes from the interest on their customers, which was $3.5 billion last quarter. At the same time, lower interest rates make it easier for them to grow, which is their focus right now, and it increases the number of transactions that happen online. And PayPal actually makes slightly more money from their transaction fees. And so rate cuts are a mixed bag for PayPal, but I lean toward it being slightly more beneficial than harmful for the company, especially given their current strategy. Ultimately, PayPal is sort of a mirror of digital commerce, so if commerce declines, if there's a recession, that hurts PayPal, and if it continues to grow, PayPal benefits from that. So let's now get to the earnings on my largest overall stock holding, and just curious, I made some tweaks to how I made this video based on comments below the last video. No fluff, no music, just getting straight to the info. Let me know if you like that style in the comments. We are also on a mission to pass the Motley Fool in subscribers and make real data-backed investing research available to everyone. Most people watching haven't subscribed, and even though it makes no difference to how the video performs, it helps show traditional media that we're worth taking seriously. But one of my largest stock positions, CrowdStrike, it was actually passed recently by SoFi, is currently sitting at just under $50,000, and they just reported earnings. So CrowdStrike had a really interesting reaction after reporting earnings. They immediately dropped in price. We saw all these automated articles pop up explaining why the stock price dropped. But then the next day, the stock price immediately shot back up in price to actually higher than where it was before. But one of the reasons the stock may have temporarily dropped is they're forecasting to have a little bit slower growth going forward because they're still recovering from the world's largest blue screen of death incident that they started last summer. But more importantly, if we dive into Forecaster, the fundamentals look very strong. Obviously, CrowdStrike is an extremely rapidly growing company, and that is kind of what you're paying for if you buy this stock. But because of that, the stock can also look pretty expensive. So Forecaster gives you different options to value this stock. One of these is economic value added, which is traditionally used a lot for industrial companies, and that would value the stock at around $13 a share. But if we look at enterprise value to sales, basically how much are they worth compared to their revenue, the stock should be $400 a share. Now, I think for a company like CrowdStrike that is growing quickly and has very high gross margins, this is a better metric to use. So if I turn off economic value added, we can see that CrowdStrike is basically trading at what Forecaster says is a fair value, and that's not even accounting for re-accelerating growth. And this platform, by the way, is called Forecaster. I've been using it in basically every video. It's great for getting a quick overview of stocks, but what I like about it is it lets you kind of dive into the data in a way that a lot of other platforms don't let you. So for this, for example, we can see how the company has gone up or down based on seasonality. So we can see that over the past 5 years, looks like CrowdStrike mostly rises during the beginning of the year, trades sideways a bit during the middle, and then rises toward the end of the year. Oh, and this is really cool. I can actually highlight a specific area and then see what the average return looks like over different periods. So you can actually see that the average trade was getting 38%, but you could also look at those numbers for shorting the stock. So it looks like shorting CrowdStrike last year did not work out super well. One big risk that investors should watch out for with CrowdStrike, though, is because they're growing so much, they're continuing to issue more shares, basically putting downward pressure on the share price's ability to grow in exchange for growing the company itself. There's a ton of cool tools built into Forecaster, but if you want to check it out, I'll leave an affiliate link pinned below this video, and you'll get 10% off using that link. And if you want to see more deeper stock breakdowns, here's a video where I broke down 8 or 9 of the top stocks that I'm looking at right now.